Hey guys, welcome back to the Complete Foundation Stock Trading course. Now, in this lecture, we're going to be talking about chart patterns. So what are chart patterns exactly? Chart patterns are just patterns that you see on a chart, literally, that can give you an indication of either continuation or reversal. So they tell you if the chart is going to continue in the direction that it's going or if it might go in another direction. Okay, so why would they tell you that? Well, because in technical analysis, we say that history tends to repeat itself, and it is true. So some patterns that historically have shown a type of movement after that pattern, well, we'll believe that it is more likely that they will continue showing this type of movement after that pattern. And it makes sense. And you might say, well, no, it doesn't really make sense. How is that possible? Well, tell yourself this. Why are these patterns on charts? Because of people, right? People buy and sell stocks. And people and their emotions don't change throughout time. So if people act in a certain behavior in the past, they'll act within the same behavior in the present and in the future. So if that behavior caused certain type of patterns to be drawn on charts, well, those patterns are going to be drawn again in the future. And really, at the end of the day, like a chart, when you're looking at it, it's just an indication of historical supply and demand, right? Because it's just the prices that the stock or whatever product you're trading, the prices that that product was trading at a certain time. So, a chart really gives you a story of what the stock has done, okay? And that story, again, since it's driven by supply and demand, and because supply and demand by people, by traders, and traders are still the same type of people, their emotions hasn't changed, the same type of charts and patterns will repeat themselves. So some of the patterns we're going to look at: head and shoulders, okay, not the shampoo; double top, double bottom, double top, multiple tops. Then we're going to look at double bottoms, multiple bottoms. We're going to look at triangles. So ascending triangle, descending triangle, wedge, upward wedge and downward wedge. We're going to talk about cup and handle and the rounding bottom. So one thing really quickly. These are the most popular chart patterns that everybody uses, all traders use. And they're the ones that I have seen to work the most. Okay? Now, if you want to know about all the chart patterns that exist, there's literally hundreds. There's hundreds of different chart patterns. But you don't need to learn them. And I'm going to explain at the end of this course why. Okay? Why you only need these ones, mostly. So let's start. First chart pattern, called the head and shoulders. And this is one of the most famous patterns, actually. And why is it called head and shoulders? Well, basically because it looks something like this. So let's see here. Let me get this on. So you have a chart where the prices goes at a high, comes back down, goes to another high that's higher than the previous high. Price goes down again to the same level, goes back up somewhere approximate to the previous level here, and then drops. So in this pattern, you have what we call two shoulders. This is going to be the left shoulder, this is going to be the right shoulder, and this is going to be the head. So that's why it's called head and shoulders. Okay, here we go. And it actually makes sense, right? Because if you see here, the price is going up, so there's increased in demand for the stock. Then demand stops and there's increased in supply, so the price drops. Then demand comes back in, kicks in, goes way higher. Supply comes back in, but there's support here. And this support here, that price level, we call it the neckline. So you have your head, your shoulders, and you have the neckline. So there's support at that price, and then the price goes up again because demand comes up, but demand isn't able to push it higher than previously, right? So it actually stops at that same level and it drops again. And now the theory behind Head and Shoulders is that after the second shoulder, since it wasn't able to go as high as the previous one, there's more supply, it's going to break the neckline. And if it does break the neckline, it gives us an indication or to sell the stock. So we would expect the stock to drop if it breaks this support. Now, why does it, like, the example that I talked about supply and demand, does that really make that much sense? The thing with chart patterns is that these patterns have proven themselves historically, right? And because of that, everybody looks at them and looks for them. And because everybody's looking at them, what do you think happens when everybody sees this pattern and then the stock price breaks here? Everybody shorts it. Everybody sells it because they think it's going to go down. So what happens? It goes down. So does it go down because it's Head and Shoulders, or does it go down because everybody believes it's going to go down because it's Head and Shoulders, right? So nobody really knows, but it's a self-fulfilling prophecy because everybody believes it, it happens, right? So it could be it happens because it makes sense, or it could be it happens because it's a self-fulfilling prophecy and everybody's doing it. But regardless, it happens, right? So you have to follow it. And it's so popular that let's actually get on Finviz. So if we go on finviz.com, and there's actually a section here for indicators, right? This section here, you can look, and we looked at that before for trend lines. There's actually a section for Head and Shoulders, right? It's super funny because this website, everybody uses it. And they have a section specifically for that pattern. And then you can look at charts where they believe that there's a head and shoulder. Oh, left head and then right shoulder. Obviously, well, this one never broke and it doesn't look really good. So you gotta make sure you go through them and find one that looks good that everybody else is gonna see, right? Obviously, Finviz, they have their algo that looks for them, and it's hard for them to find for a computer to look at charts. But regardless, why you want one that looks good? Because you want one that everybody else is going to be able to see. Because if you're the only one who sees it, then why would it work? You need other people to see it. Because at the end of the day, your objective is, it's not just to predict where a stock is going to go. Your objective is to predict what other people are going to do. Because what they're going to do is what ultimately is going to drive prices. So if you see a pattern that nobody sees, well, what use is it for? It's not useful. You want to make sure you see a pattern that other people are going to see. Or if you can see it before they see it, that'll actually be even better, right? Because what you want is to have a position before the supply or demand comes in, right? So this is one of the patterns. You're not going to see this one as much, but when you see it, a lot of people do follow through with it. So make sure to look for it. Okay, now this pattern is actually called the double top, and this is actually one of my favorite patterns, and there's a reason for that. The reason for that is it actually means something. There's a fundamental reason why it works. It's not just a self-fulfilling prophecy, or we don't know. There's legit reason why this works, on top of everything else, on top of the fact that everybody looks at it, on top of the fact that it's self-fulfilling prophecy. So a double top is basically what its name says, right? I guess you all know what it means by now, and it's pretty clear here. It's a chart that topped at two different locations. So it went to a high, then traded somewhere else, then came back to that same high, wasn't able to break it, and came back down. So now what do you have? You have two tops. So what that tells us is this price level is a resistance for the stock. The stock is unable to break it. Hits it here, isn't able to break it. Hits it here, isn't able to break it. So then you know that this is a resistance, so the stock is going to have a hard time breaking over it. So you would think that it is way more likely to fall down than to break that level. Okay? And what are the reasons behind that? Well, maybe there's a big seller at that price. Maybe somebody has a big order, right? Because we've talked about orders before. Prices move up and down because of orders. If there's a lot of people who are selling, or one person who's selling a huge amount of shares at $70.50 here, well, every time the price goes up, there's too many sales to sell. So even though a lot of people are buying, they're not able to push the price up, and then the price goes down. Again, comes up here, maybe the seller is still there, right? So the double tops and the other multiple tops and all of that we're going to talk about, there's actually a reason why they hit a price and they're not able to break through it, right? And that creates the double top. It's a resistance point, okay? So there's a reason why we would think that if this price goes back up here, it's probably going to bounce off this resistance again and fall back down, okay? And why? Well, is it because we saw a double top? Well, it's more because there's resistance and there's probably a seller there. But we see that through the double top, okay? Now, this is super strong. And again, if you go back on Finviz, okay, there's actually a section right here, double tops. And they have a bunch of charts where you see stocks that double topped, right? And this one at $15. Again, $15, a round number. Might be a lot of sellers at $15 willing to sell the stock at 15. So every time the price goes up there, bounces off of it. Okay? And then goes up there, bounces off of it. Okay? And it's funny for this one. So this stock actually is trading within a channel, which we looked at in the previous lecture. And this channel has the lower part of this channel is at $10. And the highest band of the channel is at $15. So two round numbers, right? And we actually talked about that in the previous lecture. This is funny because this is a random chart I looked at. And in the last lecture, we said, well, support and resistance and channels, they tend to be, well, not support and resistance, but we said that a lot of support and resistance tend to be around round numbers because a lot of people send their orders at round numbers. And here we go, a round number, $10. Every time the stock price goes down, bounces off $10 because probably a lot of people have their buy orders there. And again, bounces off again, and it goes to 15, bounces off 15 because maybe a lot of sellers have their orders to sell at $15, and again, bounces back off on 10. So you see how all of these are making sense. And even the double top, well, look, happened at $15 at a round number. So what we would expect if this stock was to go up again and go to 15, it's very likely that it bounces off of it and drops back, right? So that's what a double top would tell us, that if you want to get into a short position, get into it somewhere here, because it's very likely that it's not going to be able to go above that line, that resistance line, and then it's way more likely that it'll just fall down, right? So how I love these double tops. So when you're looking at double tops, we just looked at a daily time frame. We're looking at a daily chart, right? But the thing is, you could look at double tops on any type of time frame. You can look on a daily chart, on a minute to minute chart, on a 5-minute chart. So you can look intraday, what happened within the day. And you might see that a stock, let's say at 9:30 a.m. is trading at, $9. And then by 10, it goes, so this is 9:30 a.m. It's trading at 9. And then by 10 a.m., let's say let's say it's trading at $10. And here's price, and time. And up until the close of the day, which the close is, let me put this here, the close is at 4 p.m. Well, the stock fluctuates, and maybe every time it goes to 10, it bounces back off of it. So we have a double top here, right? One top, two tops. Now, when you're looking intraday, within a day, double tops actually mean way more than if you're looking on a daily chart. Why? Because let's say in the example we looked at, the double tops, the first top happened, I don't know, in June. And let's say the second top happened in September. Well, if this resistance, okay, let's call this the resistance, okay, which this resistance here is probably caused by a lot of sellers, right? High supply, a lot of orders to sell. The supply that was here in January, these guys that were selling, are they still here in September? You know, or if it has a double top, maybe June, July, okay, let's say this is July, and then September is here, let's say, a few months later, the stock, you know, fluctuates and it comes back and it tests this level. Do we expect that this resistance, okay, do we expect it to hold? Do we expect that the same sellers that were here, that supported that price, made the price, were a resistance to the price couldn't break through them, are these orders still here several months later? We don't know, right? Maybe not. Maybe they got their positions and they're done and now things changed. But when you're looking intraday, you know, if at 9:30 if at 10 p.m. at 10 a.m. there was a big seller here and the price couldn't break that and came back down, then at 10:30 a.m., 30 minutes later, you know, again it came back up and it couldn't break that price because maybe, you know, that seller is still there. With maybe at 11, let's say, let's call this 2 p.m., you know, a few hours later, if it goes back there, well, it's still very likely that the seller is still there and that this resistance is still going to be there, right? So it's actually stronger in the shorter term, because in the shorter term, whatever caused that double top is still there. It's very unlikely that it's not there anymore, okay? Now, on the other hand, when you're looking at daily charts, everybody's going to see that support and resistance, right? Because this is intraday. So within the day, not a lot of people are looking at it to see that price. But everybody looks at the daily chart. Everybody looks at the long-term charts, okay? So if there is a double top at one point and you see this resistance, a lot of people are seeing it. So a lot of people are using it as well. So they both work in their own way, and they both mean something, even on the longer term or even in a short term within the day. So you can use it across the board in terms of time frames. And this is why it's a very useful pattern. Again, if everybody sees a double top at a certain price, okay, double top, then what is everybody gonna do if they want to sell the stock? If they want to sell it somewhere around here, they'll sell it here because they know that it's very unlikely that the stock goes above it. It's very likely that the stock goes here. So they'll all send their sell orders here. And by having so many sell orders here, well, the stock is not going to be able to break above that price, and it's probably going to top at that price again. So again, it's a little bit of a self-fulfilling prophecy again, but it actually relies on something fundamentally true, and that makes a lot of sense. So this is why, you know, this pattern specifically makes a lot of sense. Okay. Now, let's check another one out. Next one, multiple tops. What a surprise, right? So multiple tops is exactly the same thing as double tops, but you've guessed it, there's more than two. So you have a top here in this chart, another top, and then another top. Now, what's the difference? Well, the difference is the fact that it actually tested that price another time, and another time it failed at breaking it. So it makes that resistance or that top even stronger, right? Yeah, if it hit it twice, it means something, there's big resistance, but if it hit it 3 times, 4 times, 5 times, it gets stronger and stronger and stronger as more and more people see it, and more people believe in it and put their orders at that prices and make it even stronger, right? So, and again, on any time frame that would work, any time frame. Let's get back to Finviz. Again, in Finviz, there's a section for multiple tops. And you can look through them and you're going to see a bunch of different charts where you have something that hit a top several times and it couldn't break through it. So this stock, for example, every time it hit that $2.50 range, couldn't break over it. Here. Okay, then comes back, tests it again, can't. Tests it again, can't. Tests it again. So when you're looking at, and again, you see this channel, moving within a channel. When you're looking at a chart like this and a stock it's unable to break a price level, okay? In this case, the $250 price level. What is it telling you? Like, how can you make money off of this? Well, you can short the stock somewhere here, okay? And let's see here. Let's draw here a bit. Let's put a blue color. Okay, so you can short a stock here at, let's say, okay, well, this pen isn't really working well. So let's say you short here at 250, okay? And you try to get out somewhere here at, let's say, 220. So you can make a 30-cent profit if the stock drops, right? So you can make 30 cents just as the stock drops. Because it's extremely likely that the stock drops from here to here, then the stock breaking over that huge resistance and going up, right? At the end of the day, to make money in trading, it's all about probabilities. You're taking a bet that a price goes in a certain direction. And you're never going to be 100% right? You're going to be wrong sometimes. But what you want to do is be more right than you're wrong. And when you're looking at something like this, what do you expect to happen? Is it more likely that this price falls, or is it more likely that it breaks a resistance line that it was unable to break before? Obviously, we'd all agree that it's way more likely that it goes here. So you can short the stock here, 250. If it drops from 250 to 220, you take out your profit here. Obviously, you take it out here. You don't try to make more money because here also there's a support. So it's unlikely that it falls below here. So you make 30 cents profit. And if it breaks over here and it goes to 261, let's say, above 260, because it never went above 260, well, take your loss. Then you lose 11 cents. So you either make 30 cents or lose 11. And honestly, just simple strategies like this, okay? You can make way more money than some overly complicated strategies that nobody knows about. Because the thing is, you want something that other people see. Because always put this in your head. Why a stock is going to go in a certain direction is because other people believe it's going in that direction. And they buy it or sell it expecting it to go there, right? So if you're doing something that, not other people are going to be doing and helping in that, in making that move happen, then it's not going to happen, right? So something like this that everybody looks at, and again, if anybody looks this stock up on Finviz, Finviz literally shows them the multiple top right away. So everybody's seeing it. There's actually a section for it and it pops out, right? So this makes a lot of sense, okay? All right, so let's clear this out. Let's see here, clear. Okay, so next pattern. Let's take this off. Next pattern. It's double bottom. Okay, so double bottom, you guessed it, right? Same exact thing as double top, but it's at the bottom. Okay, so stock price is fluctuating, falls down to a certain level. Oops, can't break that level, goes back up. Oops, can't bury that level, goes back up. And again, look at this, how funny. At $14 is the support. Again, a round number, right? Probably a lot of people have their buy orders here. Price wasn't able to break through. A lot of people think that it's a very good price $14 to buy that stock, so they're buying it there. They're not letting it go below. Too many buyers at that price. And it goes back here. So again, that stock, if you're looking to buy it, buying it at 14 is an extremely nice place, right? Because it's very unlikely that it breaks below it and goes down. So if you buy it here, you have a lot of chance of making money as it goes up. A very low chance of it breaking down and then losing money. Okay? You guessed it. Multiple bottoms. Same thing as double bottom, but you have multiple ones. So touches a support level, touches a level, goes back up, touches that same level again, and touches again. So 3 times or more. Again, if you're looking to buy that stock and you put a price just over here, if you get it, it'll be a good price because unlikely that it falls below. So it's the same thing as double tops and multiple tops. And if we go again on Finviz, you'll see that there is a section for double bottoms here. So same thing. Look at this one. This one is at $5. So it's going in a downward channel, but then when it touches $5, it goes back up to $6, touches $5, and now it's here. So this is a good place to buy it. Why? Because if you buy it here and it goes up, you make some money. If it breaks down, well, you take a loss, a really small loss, right? And that's it. So your potential for gain is way bigger than your potential for loss, and your probability of losing is way smaller than your probability of winning. And if you keep repeating this type of trade, you're going to make money. Why? Because yes, sometimes you're going to lose, but not a lot of times. And those times you're not going to lose a lot. But the times that you're going to win more, and they're going to be more often. And even though sometimes you lose, if you keep repeating those those trades, if you keep repeating it, just the amount of money and times that you'll win compared to the amount of times and money that you lose is going to be way bigger. So you're going to be profitable, right? The important thing is to keep repeating it. So that's a double bottom. And again, they have a section, multiple bottoms. Okay. And in that section, same thing. Stock touches a price level, touches a price level, touches a price level, is not able to break that price. So really, I suggest you check out this website, check out Finviz, check out some of the charts they have, and see if you can recognize some patterns and paper trade them. Okay, paper trade those patterns and see if you would have made money by just following simple, robust, meaningful patterns like these ones. Okay, so give them a try. Now, next pattern we're gonna look at is gonna be, let's see here, put this up, triangles. Triangles are also some of my favorite and most useful patterns. Why? Because they're actually meaningful, right? They mean something. When you're looking at a triangle, what are you seeing? What is it telling you, right? When I look at something like this, again, first of all, the reason why they're called triangle, because you can see here, it looks like a triangle. You have this line, which is a resistance line, and you have a support line. Now, there's 3 different types of triangles. You have the ascending triangles, you have the descending triangles, and you have your regular triangles. Ascending triangle, and this is the first one we'll cover, is one that is the support is going up. Okay, so you can see that triangle is going up in a way. Now, when I'm looking at this, what does it mean when you look at something like this? What is this chart telling you, right? Because that's what really you wanna understand is, what is this chart, what is its story, right? So when I'm looking at this and I'm seeing the price going up, okay, and then I see it goes up a bit, comes back down, but I see here it doesn't go as low as it was here. So it seems that buyers are being more aggressive and wanting to buy it at a higher price than they were willing to buy it earlier, right? So let me put this on. So buyers at this point, people were buying it here, then it goes up, they're buying it at a higher price. Okay, they're being more aggressive. Now the price goes up at this price level, and then sellers start selling. Okay, a lot of selling pressure here, so the stock price goes back down. Now buyers start buying, but again at a higher price than here, and this one at a higher price than here. Price goes up back again at the same price. Sellers, too many sellers here. Downward, more supply, so price goes back down, and it doesn't go as down as it was here, right? It doesn't go as down as it was here at the same price. So buyers are being more and more aggressive. They're willing to pay more and more for that stock. Okay, not sellers though. Sellers are always selling at that price here. They're being more aggressive at that price. So here again goes back up. Sellers sell. Sellers are selling. You see here the price is unable to break that level, the 96, 95 level. But then it falls here, and you see buyers are being more and more aggressive. They just want to buy it. So what do we expect to happen on an ascending triangle? Well, we're seeing that the price is getting wedged within the triangle, and it's getting, really the buyers are being so much aggressive that they're nearing the sellers. Okay, so at one point somebody's gonna win. Either the buyers are gonna be like, hey, we're gonna buy everything at that price, or the sellers are gonna be like, hey, we're gonna sell everything you need and we'll sell some more, so the price is gonna drop. So somebody's gonna win. But from this chart, we can see that the person who is being more aggressive, who's being more impatient, are the buyers, because they keep buying at a higher price. So what usually will happen is that the triangle will break to that direction. Okay, prices will break over here and then it'll fly. Obviously, it doesn't happen all the time. Sometimes it breaks down, but most often, again, it's a probability thing. Most often, this is what happens. So what would you do and how can you profit from that? You just buy it here and expect this to happen? No. You wait until it breaks over this level, right? So let's clear this. You wait until the price breaks over here and then you buy. Because at that price, everybody sees that there's an ascending triangle. Well, everybody saw it already, but nobody buys before there's a break, because people know that, okay, well, hey, it has to break at one point here. Where is it going to break? Is it going to break for above, or is it going to break below? So everybody's watching that, and as soon as it happens, what do you think happens when the stock price breaks here? Well, everybody who was short the stock, okay, who was using this as a resistance point, because they thought the price was going to go down. Well, if it goes up here, they'll be like, okay, I lost, I'm going to take my loss. So they're going to buy it. They're going to buy back their short position. They're going to cover their position. And when they do that, what happens? Well, the price is they're going to buy it, so they'll push the price up, right? And other people who weren't short, who just wanted to buy, that didn't buy here because they know that there's resistance, well, once that price breaks that resistance, they'll want to buy it. So also they're going to be buying it here. So again, more upward pressure here, because there's so many more buyers. So what you want to do is you don't want to buy in advance. When this happens, that's when you buy. When it breaks, okay? So you want confirmation before doing what you want to do. So if you buy here and it goes up, you make your money, super good. If it doesn't and it actually comes back down, well, you take a small loss, right? But more often than not, you are going to be making that money. Now, another pattern, and let's take this drawing off, is going to be, let's see here, descending triangle. So descending triangle is exactly the same thing as ascending triangle, but you guessed it. So the sellers are the ones that are being more and more aggressive, right? So it's a triangle, but you can see that it's going down in that direction. So you have buyers who are buying the stock at a certain level. They're consistent in the level that they're buying at, okay? This is what they perceive as a good price. Now the sellers, they were selling here before, but then they're selling at lower and lower prices every time, okay? They're being more impatient. They're willing to sell at a lower price, and that's why you see this type of pattern, right? So this is what this chart is telling us as a story, that, hey, the sellers are being more and more impatient. They're selling, they're selling, they're selling, they're selling. So now what do we expect to happen here? Well, obviously, either the stock price, okay, either the sellers are going to be so aggressive that they're going to sell, and they're going to sell so much that these buyers aren't going to want to buy anymore. And the sellers are going to push it down finally, right? Or maybe not. Maybe the sellers are going to come and they're going to sell, but then there's too many buyers here, and then the price is going to go up again. So that's why you don't take a position before the break happens, because you actually don't know. Yes, it is more likely it breaks down, but you don't know if it is or if it isn't. So what you want to do is wait until it breaks down, okay, and then get in, because then it could then short here, wait until it happens, it breaks, you have a confirmation, and then short. And then if it keeps going down, you make your money, okay? So again, you don't want to take all the trades. You want to take the high probability trades, right? Because there's so many stocks out there. There's so many opportunities. You don't need to jump on anything unless it looks really good, okay? So if it doesn't look as good, find something else. You're going to find something that looks good, okay? And just take the best trades. So and again, it makes sense, right? And not only does it make sense, but tell yourself this: a lot of people are looking at it, so that's why it'll work. Okay. Okay. So another pattern. Let me take this one off, and they're all the same, right? So a regular triangle. Okay. So this isn't ascending or descending, and we actually call this one a wedge. Okay. So since it's a triangle. But it's not ascending or descending, we call it a wedge. And in this one, you'd see that, okay, well, sellers are selling at lower and lower prices. They're being more impatient. And then buyers are buying at higher and higher prices. So they're also being more impatient, right? So you'd see that the price is getting wedged here, right? It's getting wedged because they're both being more and more aggressive. So what is going to happen is at the end, somebody's going to win, either the buyers or the sellers, right? And it's going to break out in one direction. So a lot of people are going to be watching this, right? A lot of people are going to be watching this pattern and waiting to see which direction is going to break in. Because once it breaks, then they're all going to be going in that direction, okay? In this case, it broke upwards. So the buyers won and went from $32 to 34. Now, sometimes it keeps going, and sometimes it comes back and it tests this level, and then it keeps going, right? And sometimes it might just come back again, but this is, again, way less likely, and we're not in the business of always being right, but being right most of the times, okay? And again, what did we talk about last course? Resistance, once it's broken, becomes the new support. So when you buy above this resistance, you're pretty good. You see it went up. In this case, it didn't keep going up. It came back, but it's supported there. And it's way likely that it keeps going up. So very good patterns. And again, if you go on Finviz, look at this. There's a section for it. Ascending triangles. Here we go. How good does this look? Okay. Here we go. Okay, so if it does break over that price level, which is 39, right? It never broke 39, tested it every time. Buyers are being more and more aggressive. Okay, tests the 39 level a bunch of times, is unable to break it. What do you think happens when it finally breaks it? Right? And again, you see, buyers are being more and more aggressive. This is a super nice chart. Again, there's a bunch of them. There's a bunch of them, and they all, look at this one. Here we go. Look at this pattern. You cannot not be seeing this, okay? So imagine if it breaks over that level, okay? Right now, imagine it just breaks. You know this can go, right? And again, this is ascending triangle. You can go and look for descending triangles, okay? Same thing. You'll find some pretty nice charts for ones that are descending, okay? Wedges. Here you have wedge down, wedge up. So you have all the wedges as well, right? So you can see symbols that are being wedged in a zone, okay? and that are very likely to now explode. You know, the further they go within the wedge, right? The further they go within the wedge, the stronger they'll explode. So if I have a wedge, and let's see here, if I have, let's say I have these two wedges, okay? I have this wedge and this wedge. If I have a wedge where, the price went up, went down, and then it broke here, yeah, it might go a bit. But if I have another wedge where, the price went up, went down, went up, went down, went up, went down, went up, went down, and now it's so, it went so far in, when it breaks, it'll really explode. And this is just something that we see all the time. The further they go, the further they're wedged, the longer they stay in it, the stronger the explosion. Okay? And again, we see this on every type of time frame possible. We see it on daily time frames, and we see it on intraday, right? So you can have something that's from 10 a.m. to 1 p.m. We might have a wedge. Prices goes up at 10 a.m. Then by 10:30, 11 a.m. By noon, and then by 1 p.m. it breaks. So we see this on within a day, on 1 minute charts, and sometimes on daily charts, on every type of chart. You're gonna see it. And again, these are some of the best patterns that you can look for, because they make a lot of sense. So very simple, and they work. So why not? So other than that, again, triangles. So this is the wedge up. Again, wedges, you can have them going up or down. It's the same. And you know what? And this is why I already talked about this in the other lecture. And this is why I don't like to remember exactly which one is called what. I don't care if it's called an upward wedge, a downward wedge, an upward triangle, a downward triangle. It doesn't matter. You just got to understand what it means. When I look at this, I don't need to know what it's called. I just look at it and say, okay, well, look, buyers are being more aggressive. Oh, sellers are selling here, but buyers are buying at a more aggressive price. Oh, sellers are selling. Buyers are more aggressive. Sellers are selling. Buyers, they keep pushing the price up. Oh, this is very likely that it breaks up because of that, without knowing the name. So don't try and know the names. Try and understand, because knowing a name by heart isn't going to help you make money. But understanding the reason, that's what's going to help you make money, right? And that's why, I never ask any of my traders to remember any of those names, but I ask them to understand it, right? Because if the people who knew the most chart patterns, or they knew by heart all the names, were the ones who made the most money, everybody would be just learning the names. But it's not. It's the people who actually understand the meaning, right? What is behind it. So you have, in this situation, same thing as the triangle, okay? And you have a wedge down, same thing as the other ones, right? Price going down, but sellers are the ones that are being more and more aggressive. They're wedging them. And, oh, look at this. Looks like it's about to break. So if this breaks here a bit further, this can really go. So, again, same concept as the other ones. Okay. Now, those were the triangles. Another chart pattern that is way more rare, and that you're rarely going to see, but when you see, it does hold pretty well. And like this one and the head and shoulders, I don't like as much as the other ones, but they are valid. So I have showed them to you, right? I have showed them to you because they are valid and they are consistent and they've proven themselves throughout time. This one is called the cup and handle. Why? Because it looks like a cup here and you have a handle. So the reason I also like this one, except the fact that all traders know about, is the fact that it also makes sense. So you have price that's dropping, but then it starts dropping slower, and it's slower, and then it stops, and then it starts picking up, and it picks up way faster. And then after it does that, it actually reconciliates and then breaks up. And as it breaks up, then you expect it to go up as much as that distance. So this distance could make it up after it broke here. So again, this pattern is proven throughout time, and a lot of people look at it. You're not and you can see it again. You can see it in any time frame, right? Harder to spot, harder to see, but it makes sense in terms of the behavior. You see something dropping and it slows down, so buyers are coming in, and it goes back up to the same level. But then it doesn't drop; it reconciliates, which is a healthy thing to do after a stock makes a move, right? Because it needs to regroup and then it can keep going. So it makes sense. It reconciliates and then it breaks up again. So that's when you say, "I want my entry." Okay, and so this is very consistent. And the last one is the rounding bottom, which is again the reason I put this one on is because it looks like the cup and handle, right? Because you have prices that are dropping, but then slows, then picks up, and this very likely. So it doesn't need to have the reconciliation. Very likely that it can keep going up. Now, something I want to say about all these patterns, okay, is you can get books that have hundreds of patterns. I've met people who knew by heart 70, 80 different patterns, and they never made money in trading. Never. They thought if I can learn all the patterns, I'm going to make money. No, because most of these patterns are useless. Why would you want to learn something that's useless, right? There's patterns that nobody ever heard of before. Like you look at it, but you're the only one looking at it. What's the use, right? Because that pattern is not going to affect the behavior of anybody else. And your purpose as a trader is to predict the behavior of other market participants who are going to be trading that security and thus moving it. So you looking at a pattern that nobody looks at is not you being smart. It is you being, dumb. So don't look at something that nobody else looks at. And there's something in math, okay, that says that if you look at too much data, if you have too many variables to explain your results, you actually start losing in precision. So you can't say, okay, to predict the stock of a price, I'm going to look at these 20 indicators. It's too many indicators. You're going to do worst by looking at so many indicators than you would do by looking at just 3 or 4 indicators. So the maximum, I think the max is like 7 things that you can look at. But even that's too much. So you want to look at the most important things. If you look at too much information, you lose precision, you lose value. Okay? And then you actually get more confused. And then you look at things that don't really matter. So honestly, these patterns that I showed you here, these are the ones that we use. These are the ones that I've seen traders be profitable with consistently. And again, for example, you go on Finviz, and these are the ones that are here. They're all here. There's nothing else. Okay, so these are the most popular ones. So don't go and try and learn all these other ones thinking that, okay, well, if I learn these, I'm going to do better. No. Instead, master these really good ones and let the other ones go. Okay? So that was a bit of material here. But that'll do it for chart patterns. That being said, we're going to continue in the next chapter by looking at some indicators. See you in the next class.